Welcome back to the channel. Today, we're looking at one of the most talked about IPOs in recent months, Meesho. If you find value in calm, database stock discussions, make sure you subscribe and hit the like button to stay ahead of the market with balanced analysis every week. Meesho has just delivered one of the strongest post-IPO rallies in recent times. The stock was issued at 111, listed around 162, and within weeks it moved close to 215 to 220. That's almost a 95% gain from the issue price. But here's the important question every retail investor must ask. Is this rally backed by business strength or just market excitement? Let's break this down clearly, calmly, and honestly. Meesho is an e-commerce and social commerce platform built around value-conscious Indian consumers. It connects small sellers directly with buyers, mainly in fashion, home, and lifestyle products. The model is asset-light, no inventory ownership, app-first approach, and heavy use of logistics partners. The platform has scaled very fast, especially in Tier 2 and Tier 3 cities. So yes, Meesho has scale and popularity, but popularity alone doesn't guarantee profitability. Here's the financial reality. Despite strong revenue growth, Meesho is still a loss-making company. Why? Because growth is driven by heavy discounts, marketing spends, logistics costs, and high returns. Margins in e-commerce are thin, and competition from bigger players like Amazon and Flipkart remains intense. So what we're seeing is a company buying growth using capital, not yet generating sustainable profits. That doesn't mean Meesho will fail, but it does mean the current valuation prices in future success, not current earnings. So if profits aren't here yet, why did the stock rally so fast? The answer lies in sentiment. First, IPO excitement with a strong listing premium. Second, retail FOMO after quick price gains. Third, early analyst optimism and narrative building. But remember this, stock prices can move faster than business fundamentals, especially in the early post-IPO phase. What we're seeing now is sentiment and momentum at work, not true value discovery. Now, what should retail investors notice? 1. The company is still loss-making. 2. The valuation is already rich compared to earnings visibility. 3. E-commerce is an execution-heavy business. And 4. Early IPO rallies often attract traders, not genuine long-term investors. History shows many post-IPO stocks correct sharply once excitement fades and quarterly numbers start coming in. Technically, the stock trend is strong, no doubt. But strength near highs also means the risk-reward becomes unfavorable for fresh entries. Support sits around 180 to 190, while resistance lies near 220 to 240. After such a vertical run, downside risk often outweighs upside comfort. So what's the ideal investor strategy here? For short-term players, this is not a low-risk zone. Chasing momentum can be dangerous. For long-term investors, patience is smarter. Wait for profitability visibility. Wait for a few stable quarters, and let the valuation cool down. Remember, good companies don't vanish if you miss the first rally, but bad entries can hurt for years. The final takeaway, Meesho is a strong brand with real scale, but not yet a proven profit machine. The current rally looks driven by excitement, not earnings. Rising price does not mean lower risk. A loss-making business mixed with hype is always dangerous for retail investors. Smart investors wait for numbers. Emotional investors chase price. If you found this analysis helpful, make sure to like this video, subscribe for more calm and data-driven stock discussions, and share it with someone who's considering new IPO investments. See you in the next one.